Plug Power is currently trading at $3.46, showing a modest gain of 1.91% for the day. While many retail investors might see this small green arrow and feel a flicker of hope, this minor intraday uptick masks a far more critical and unsettling reality brewing beneath the surface. The real story isn't about today's 2% gain. It's about the staggering amount of capital betting against the company's very survival, a pressure that this small bounce does little to alleviate. Most traders are conditioned to watch price, but the smart money is watching the cost to borrow shares, and right now that cost is telling a story of extreme skepticism. The common belief is that Plug Power is a cornerstone of the future hydrogen economy, a company with groundbreaking technology and key partnerships with giants like Amazon, Walmart, and Home Depot, positioning it as a definitive long-term winner in the green energy transition. The narrative is powerful. A world powered by clean hydrogen, with Plug Power providing the essential infrastructure. Investors have bought into this vision of a decarbonized future, seeing the stock's massive decline from its highs as a generational buying opportunity. They see government support, like the Inflation Reduction Act, as a financial backstop that guarantees eventual success. This optimistic view, however, collides with a brutal operational reality. The company's been in business for over 2 decades and has yet to post a full year of profitability. The core issue remains the economics of hydrogen itself. Green hydrogen, produced using renewable energy, is still prohibitively expensive to produce at scale compared to fossil fuels. Plug Power's business model is incredibly capital-intensive, requiring billions of dollars to build out the necessary production plants and infrastructure. This has led to a relentless cycle of cash burn and shareholder dilution through secondary offerings just to keep the lights on. The expectation is that government credits and economies of scale will eventually solve this problem, but the reality is a race against time. The company is burning through its cash reserves at an alarming rate, and if their new production facilities, like the one in Georgia, don't ramp up perfectly and achieve projected cost efficiencies, the path to solvency becomes incredibly narrow. The market is slowly waking up to the fact that the vision is years, if not a decade away, while the financial pressures are here and now. Today's slight upward movement is occurring on relatively average trading volume, suggesting a lack of strong conviction behind the move. It looks more like a minor reprieve in a persistent downtrend rather than the start of a meaningful reversal. Looking at institutional ownership, recent filings show a divided house. While some large index funds like BlackRock and Vanguard maintain significant positions due to Plug's inclusion in various ETFs, a number of actively managed funds have been truing their sticks, signaling a waning appetite for risk in the face of persistent negative cash flow and macroeconomic headwinds like higher interest rates, which make financing large-scale projects significantly more expensive. The reaction to its last earnings report was a clear indicator of market sentiment. Despite reporting revenue growth, the company missed earnings per share estimates significantly, and more importantly, the margins on their products and services remained deeply negative. The guidance provided did little to inspire confidence, as it hinges on flawless execution of their plant ramp-ups and the timely receipt of government tax credits, both of which carry substantial risk. This performance has placed Plug Power under a microscope, particularly with short sellers who are now more emboldened than ever. The stock is currently one of the most heavily shorted names on the market. The short interest stands at a very high level, often hovering above 25% of the free float. This isn't just a handful of traders betting against it. This is a significant coordinated belief among certain funds that the company's business model is fundamentally unsustainable in its current form. The core of the short thesis is simple. Plug Power's aggressive promises of future profitability are not supported by its current financial health. Shorts are betting that the company will be forced into further highly dilutive capital raises at depressed prices, spiraling the stock value downward. They point to the company's negative gross margins as proof that it is selling its products and services for less than they cost to produce, a practice that cannot continue indefinitely. For investors, understanding this dynamic is crucial. You can find short interest data on financial websites like Fintel and Ortex, which also track the cost to borrow shares. A rising borrow fee rate is a red flag, indicating the demand from short sellers is high and the supply of shares available to lend is tightening. This can sometimes precede a short squeeze, but it more often signals deep-seated fundamental concerns. Recognizing a coordinated short attack involves watching for a sudden spike in short volume alongside the release of negative articles or analyst reports, often designed to create fear and panic selling. What's your take on the rising short interest? Smart money or manipulation? The responsible way for a retail investor to react is not to blindly jump in hoping for a squeeze, which is akin to gambling, but to critically evaluate the short thesis. Are their points about cash flow and profitability valid? If so, what is your counterargument? Your investment decision should be based on your own research into the company's ability to execute on its plans, not on a desire to fight a battle against hedge funds. The company itself, Plug Power, operates by providing end-to-end hydrogen fuel cell solutions. Its primary business has been in the material handling space, replacing lead-acid batteries in forklift fleets for major warehouse operators. This has been their beachhead market. More recently, they've expanded ambitions into much larger markets, building electrolyzers to produce green hydrogen, constructing liquefaction plants to store and transport it, and developing fuel cell systems for stationary power backup and for heavy-duty commercial vehicles. Their goal is to become a one-stop shop for the green hydrogen ecosystem. Looking ahead, the future of Plug Power hinges on a few critical catalysts. The bull case rests on the successful and profitable operation of their new hydrogen production plants in Georgia and Texas. If these plants can produce hydrogen at the company's target cost, and if the IRA's $3 per kilogram production tax credit is fully realized, it could dramatically improve their financial profile. Another major catalyst would be securing the long-awaited Department of Energy loan guarantee, which would provide access to cheaper capital and serve as a significant vote of confidence from the government. Conversely, the risks are immense. Any operational delays, cost overruns at their new plants, or a reduction in government subsidies could be catastrophic. Competition is also heating up, with industrial gas giants and other energy players entering the hydrogen space. The biggest risk, however, remains the company's own balance sheet. Without a clear and rapid path to positive cash flow, the specter of further dilution will continue to hang over the stock, suppressing any potential rally. Comment below how many shares of Plug Power you currently hold. The story of Plug Power is the ultimate clash between a compelling, world-changing vision and the harsh, unforgiving economics of bringing that vision to life. Today's minor price increase is ultimately insignificant in the grand scheme. The real question investors must answer is whether the company can bridge the gap between its ambitious promises and its current financial reality before time runs out. The expectation of a green energy revolution is powerful, but the reality of the balance sheet is what will ultimately determine the fate of Plug Power and its shareholders.